Now, Mozambique Central Bank left its key lending rate unchanged at 11.5%. What were the main considerations behind this event?
Well, we would have expected that they did indeed have room to cut interest rates further, as they have been doing. Yes, I can. Can you hear me, Ken?
Yes, I can hear you, Yvette. Go on, Yvette.
All right. Yes, so in Mozambique, we had expected that they may have actually opted to reduce their interest rates again, as they have been doing over the most recent months. This is because we've seen very sharp disinflation in Mozambique, and inflation in July again fell to a record low. If we look at the national measure, inflation is at now 1.9%. So obviously relative to its reference rate of 11.5%, this, in our opinion, gives them ample room to cut rates further. We have overseen that they've cut aggressively over recent months, and the reason they may have paused in this interest rate cutting cycle is because they have become slightly concerned about the currency. The currency has weakened somewhat in recent weeks and is now again trading above 29 against the US dollar. And this is an accelerated depreciation trend after months of stability and obviously the very sharp appreciation that we saw last year. I would argue that they are becoming increasingly concerned about economic growth. The external sector is facing pressure from lower commodity prices, both in the aluminium space as well as the coal space. So they could potentially be using the weakness of the currency to stimulate the external sector. But I would argue that also, as in light of the sharp disinflation we've seen, they would have room to further cut interest rates to further provide stimulus to economic activity.
And Yvette, you've seen traditionally Mozambique relying on foreign donors, to stimulate its economic growth. And I think you've just mentioned about the currency. What sort of impact do you think this is going to have on the country moving forward?
We do see indeed that their current account is relatively well supported by donor inflows. They have notoriously been one of the largest recipients in Africa of foreign donor aid. So for their budget, I believe it's about 20% that they receive in terms of donor support. Increasingly, they are, however, turning to loans from international development institutions rather than grants. And we're seeing that external loans in very concessional terms is a very important source of financing for the budget deficit, which is quite wide this year relative to last year as they seek to stimulate economic activity. In terms of their current account deficit, however, growing imports and a slower growth than expected in exports is seeing that current account deficit remain remarkably high at close to 12% of GDP. So they're mainly still relying on financial inflows, so in the form of, as I mentioned, concessional loans, but also in the form of foreign direct investment, which is becoming increasingly important to finance that very wide current account deficit. That wide current account deficit is to some extent also to explain obviously the volatility and now upward pressure that the currency might face. However, in general, we do feel that financial inflows will remain very supportive in the medium to long term.
Yvette, another country making news is Namibia, and we saw the consumer inflation accelerating to 6% year on year from 5.6 in June, and that was for the month of July. What direction do you think the MPC will take as far as the rates are concerned in the country, for the country?
Well, we do expect them to follow the SARB. They obviously are part of the CMA region and are very much tied to the monetary policy as is being conducted by the SARB. It's important to note that this increase in inflation was regardless of the fact that food inflation has been very benign over recent months. We do expect food inflation to perhaps face some upward pressure over coming months as cereal prices rise. But it's more important to note that this rise in inflation, in our opinion, is likely to have been the result of an upward adjustment in electricity prices in July. With 20% of the of the CPI basket comprised of utility and housing prices, this increase in electricity prices has had quite a large bearing on the CPI basket. So moving forward, that's likely to see that penetrate through to other elements of the economy. But this does not take away the link that they have to SARB monetary policy and, of course, their desire to stimulate economic activity. So while we feel that inflation may rise, contrary to what we've seen in terms of disinflation in South Africa, we do feel that they will indeed cut interest rates in line with SARB.
Very briefly, Yvette, talk to us about inflation in Angola. We've actually seen it recording at 10.1% for the month of June. And historically from 2001 up to 2012, it was averaging 46.6%.
So we have indeed seen a disinflationary trend in Angola. It's been quite slow when compared to what we've, for example, seen in Mozambique. So inflation now stands at 10.1%, 10.01% from 10.1% last month. This is very close to the central bank's objective of 10%. They have introduced a reference rate, a central bank reference rate, as of October 2011, which they've only adjusted downwardly one time when they adjusted it downwards to 10.25%. Which was a reduction of 25 basis points. While that reference rate is a welcome development in terms of offering a signal of the stance of monetary policy, we continue to feel that their exchange rate is the main anchor of monetary policy. And we've seen that they've been very secure in terms of the way they've managed the exchange rate, which has depreciated very marginally against the US dollar. We've seen that the external reserves have continued to grow, and so we feel that the central bank will continue to manage the exchange rate in this way, seeing it remaining relatively stable in the short to medium term, and therefore allowing for the stable exchange rate to feed through to stable price developments. So that will be their main and remain their policy anchor moving forward.
Thank you very much. That was Yvette Babb from Standard Bank.